Hello and welcome to the first episode of Risk versus Reward from bl.Portfolio. To take this discussion forward today, we have with us a chief of the portfolio team, Hari Viswanath. Hi Hari, wonderful to have you with us today.
Hi Bharat, thank you so much for initiating this first episode of Risk versus Reward from bl.Portfolio. For a long time, me and my colleagues have been wondering how to explain more of what we write every week, the Sunday edition that we bring out. We've got a lot of mails from readers asking us to make podcasts and videos of our content. So we are making an effort here. Thanks for joining in, and we hope to make it bigger going forward.
Awesome, thank you. Hari, I'll probably kick off this episode with a question that's been intriguing for me.
Yeah.
And I'm going to take off from both the page ones that we had in the Sunday previous to last and the last Sunday.
Okay.
So the Sunday previous to last had an interesting headline where love for equities is actually adding to India's BOP or balance of payment stress.
Yes.
And I was like intrigued, are we actually buying stocks in dollars? Is that adding to BOP? Obviously that's not the case. And I'll let you explain this for our viewers in a lucid manner. And then I'm going to twin it with the next Sunday edition's page one that we had, where your team actually threw a ray of hope for investors when it came to Nifty 50. And I've always admired the lucidity with which you've explained, saying there are times when we have to be cautious, there are times when we can be slightly more risk-taking because the rewards are higher.
Yeah.
So can you look at both of these articles and give me a consolidated answer?
Yeah. So these two articles back to back, right? One was on the May 17th edition, and the second article is on the May 24 edition. These have to be seen in the context of trying to identify a middle ground rather than holding on to extremes. Okay, whenever the currency falls, we hold on to extreme. Whenever markets zoom a lot, we hold on to extreme. But we have to keep in mind that there are excesses in markets, whether it is the currency market, whether it is the equity markets. So best not to get carried away on the positive side or on the negative side. Okay, so let us just look at what the numbers are saying. So last week, why we said not just love of gold but love of equities also is because Prime Minister had made an appeal to Indians to reduce consumption of gold, and his call is right. We do have a little bit of a problem. I wouldn't say it's a big problem because we have faced this crisis. We go through a cycle, we get it fixed, and then we again do well again. So a cycle in the currency depreciation is playing out now. It did in 2013, which we fixed. It did in 2018, I think, 17 or 18, when the rupee depreciated from 67, 68 to 72, 73 in a matter of couple of months. Okay, so then we fixed that, and then we had a good and then we kind of had a stable phase in the currency till COVID struck. So it's a cycle. Okay, so we want to bring out some salient fundamental points for our readers to take note of. Okay, number one, yes, gold imports for India has actually gone up from around 1.3 to 1.4% of GDP to close to 2% in fiscal FY26, largely because gold prices have gone up. I think our volume imports have largely remained the same. It's not like the volumes have gone up, it's more to do with the gold prices. All right. Oil imports have gone up, like when crude prices were lower in FY21, petroleum imports were at 3% in FY21. Okay. Today it's at 4.5% for FY26. But in FY22, it went up to 5% of GDP. Okay, when I say the numbers, it's as a percentage of GDP. And but the rupee depreciated only by 3.7% in FY22, when petroleum imports was 5%. When petroleum imports were at 6.2% of GDP in FY23, the year of the Russia-Ukraine war, the rupee depreciated 8.4%. Now when petroleum imports are at 4.5%, the rupee has depreciated 11%. Okay, so there have been years when we've had 5% petroleum imports, but rupee fell only 3.7%. So what is different? Why are we having at 11% depreciation in the currency when petroleum imports is not far superior to previous years, right? So one thing that needs to be noted is FII exits. Okay, we've had years of FII exit. FII exits, net FII outflows in FI 26 is at 0.5% of GDP. Last year it was at 0.4% of GDP. We've had FII exit at 0.6% of GDP in FI 22. The rupee fell only 3.7% that year. So what is happening is not that gold is higher, gold imports are higher, petroleum imports are higher, and FI exits are higher. The problem is everything is happening at the same time. Okay, we have FI exits, we have high gold imports, we have high oil imports, and we have high FDI repatriations. Okay, so when all this happened, there is a pressure on the currency. Now, in this case, why are FDI repatriations and FII exits happening? This is happening because FIIs find India unattractive for two main reasons. One is that compared to FY20, when US bond yields were at 1%, the 10% bond yield, today they're yielding 4.5%. They've been in a consistent upward slope over the last 3-4 years, okay? And that's because we all know the developed markets have had high inflation. So that is one thing. Then the other thing is they find more attractive AI plays in the US, in Japan or in Korea, and few other countries, okay? And then there are a few other commodity plays like Brazil, which is a commodity play. So they find relative attractiveness either in the US bonds or in German bonds or in Brazilian commodity stocks, AA stocks, okay? So India is losing out because of that. So we do have FII exits at close to 0.5% of GDP. So this happening at the same time as higher gold imports and higher oil imports is combining to create a problem. So I told you 4 things: FII exits, FDI repatriations, gold imports, and petroleum imports. So these all see outflows of our currency. Then there is another issue, tariff wars. Tariff wars have impacted merchandise exports. Okay, geopolitics and tariff wars have impacted merchandise exports. So we have 5 negative structural factors hitting the economy at the same time. So we have to take it in context when we look at the currency depreciation. So maybe if 2 out of these 3 weren't as severe as today, maybe we won't be having as much pressure on the currency as we are facing today. Okay, so we wanted to highlight that it's not just gold, oil, it's few other factors, including equities, because we are a business paper, we are focused on fundamental valuation in stocks and the markets. So we wanted to point out that Indian markets are expensive. You take it, compare it with most economies globally, developed and developing. There is a huge inflow of money from domestic participants in the markets. FIIs find India unattractive, so we are offering it to them on a platter.
So that's where the love of equities by Indians is allowing FDI repatriation, and that's adding to, oh wow, beautifully put.
Yes, so and FDI repatriation, I've seen many criticism in media and amongst few other economists that India is not attracting enough FDI. I'm not sure if that is correct, okay, because if you look at the page 1 article that we published on May 17th, FDI inflows are still good at around 2% of GDP, okay. So it's been between 2 to 3% in the last 5 years. It was at 2.6% of GDP in FY26. Now, if you look, I'm not sure to say whether on an absolute level it is good or bad, but looking at our history, it's quite good. FDI inflows haven't been bad at all. The issue is with FDI repatriations, which is mostly via either dividends or IPOs, right? There have been many IPOs at very expensive valuations, and PE funds and foreign owners have been exiting the IPOs, and the money is getting repatriated. Now that is going up. So these are all the factors. So the reason why we wanted to say not just love of gold, or it's also love of equities. See, our job is to let investors, readers know which is a relatively attractive asset for you. Okay, in a judicious asset allocation, you need to be exposed to all assets, but you need to see how you can relatively adjust. In that context, if you are cutting down on gold imports because that is causing a BOP problem, there is one more factor to consider, which is import of ownership of shares. All right, we are importing when we buy from an FII or when we subscribe in an IPO where foreign investor is exiting, which is an FDI repatriation. We are importing ownership of shares. We are importing ownership of companies listed that are going to be listed or are listed in the Indian stock exchange. If it is an IPO, it's going to be listed. We are importing that also. So like gold, this is also an import in my opinion. Importing ownership is all good if you're doing it at the right valuation. But when we are doing it at an expensive valuation, while the long term will be the judge on whether the buyer or the foreign seller or the Indian buyer is right, we have to take cognizance that it is being done at an expensive valuation. The one specific example we mentioned in that article was what the Whirlpool global CEO called as an asset arbitrage, right? He said how when the parent company Whirlpool Inc. in USA was trading at very low valuations, okay, whereas his Indian subsidiary was trading at over 50 times, they used it as an opportunity to reduce their stake and repatriate the cash to reduce the debt at the parent company. So that asset arbitrage is playing out. So who is right? We will know. But when you buy at expensive valuations, the chances of being successful are lower. So that's the point we wanted to make.
That's interesting, and that brings us to the next part of the question, which is the subsequent Sunday's headline on May 24th, or page 1, where we said the historical performance of Nifty 50 offers some hope. So can you tie in your explanation with the love for equities?
Yes, so that part was on expensive valuations. But this article was all about, as I said earlier, extreme comments concern us, okay? Immediately I see so many views across media, print, television, highly critical of Indian markets. So what we wanted to point out is, yes, we have a problem of expensive valuation. We do have an issue that we don't have AI companies, yes, and there are relatively attractive bets. Global bonds are now more attractive and they are competition to Indian equities. When US bonds yield 4.5%, the investor is guaranteed of a 4.5% plus the principal over the next 10 years. Let us say Indian markets trade at a PE of 20 times. The earnings yield is 5%. So a risk asset is offering 5% yield versus a risk-free asset is offering a 4.5% yield. Now you have to deal with currency depreciation. If earnings grow, it can make up, but there are a lot of uncertainties. So we have to take cognizance of the challenges our markets are facing. But at the same time, it is, I think, a bit too much to berate the markets that Taiwan is up close to 100%. South Korea is up over 150%. Yes, they're all having a good year this time. But if you look at the historical performance, right? So what we did was we computed the rolling returns, okay, for the last, we computed 5-year rolling return for the last 5 years. So a rolling return best measures consistency of performance, right? On that basis, India scores quite well. So if you see, we have two charts in the article. One is performance over the last 1 year. India ranks at rock bottom, okay, when you compare with some global indices. But with the same indices, you compare the rolling returns, 5-year rolling returns, and you compare them, compare their performance. India is third from the top, okay. So we are doing quite well, okay. We are among the few countries that has not given negative returns on a 5-year rolling basis, okay. So which means what? If a foreigner is investing in India, the chances of, and stays invested for 5 years, the chances of them making negative returns is 0 based on history. Okay. Whereas if you see in China, the average negative rolling returns are 29% for the time period observed. Okay. For South Korea, which is one of the best performing markets and everyone is raving, the number is 36%. Okay, so when you look at consistency, we fare better. So what we wanted to say is, So we took off this headline, "Don't write me off just yet," what Hugh Grant sings to Drew Barrymore in music and lyrics, right? So yes, India has let you down this year. India has let down foreign investors, especially foreign investors, because when you convert it into dollars, the loss is much higher. But don't write me off just yet, okay? Because you look at historical performance, India stands a very good chance. We will have to fix a few things. One is the valuation. We may need a valuation reset. That is my opinion. But valuation is the most debated topic in markets, right? Everyone has a view on valuation. So if you're a fundamental value investor, India is an expensive market. So that is one thing. Then we may need some cooling off of bond yields. Then we may need some Indian corporates to invest in AI developed technologies, which I'm sure we are capable of. We may go through this reset phase like we did between FY12 and 13-14. Then it will turn around, is my opinion. I don't know how long this phase is going to be. So two things. One, yes, love for equities is causing a BOP stress, but don't write off Indian markets. When you have a long-term perspective, you need to gel these views and plan your investments accordingly.